Hello, and thank you for joining in today's video. My name is Nick Grantham. I'm a CPA and I'm a QuickBooks Online Pro Advisor. And in today's video, I'm going to go over something that we get very frequently. We see this a lot with our clients, and it is the proper way to record fixed assets and their payments for loans of fixed assets, and also to record interest properly. So this is a super important video and topic. So if you're watching this video, I'm assuming that you have at least a little bit of background in accounting. You can kind of understand how to get your way around QuickBooks. So hopefully in today's video, my goal is to teach you how you can add your fixed assets that have loans, that have down payments, that have monthly payments, make sure we're adding that interest as well. So this is the topic. All right. So I've got a company open here. It's a sample company called Craig's Design and Landscaping. So kind of oftentimes the first thing that we're going to see in QuickBooks whenever you purchase a new fixed asset, whether it be a new truck, an expensive piece of equipment, a tractor, something of that nature, we're going to see a down payment, right? And we won't always. Sometimes maybe you just get a loan, there's not a penny down, but let's, under this example today, assume that you put some money down. Okay, so if that's the case, when you're in your QuickBooks and you go to your transactions tab to look at your bank accounts, you should see that down payment leaving your bank account, right? So let's pretend in today's example that you put $1,200 down on a new business use vehicle, okay? So we're going to pretend that this transaction right here in our bank feed is a down payment for a vehicle. We're going to pretend that it was a truck and the truck costs $50,000 total, right? Okay, so that means we put down 1,200. The vehicle costs 50,000 after all of the little fees they tack on at the dealership. The full purchase price is 50 grand. So that means we would have taken out a loan in theory for about 48,800, and we put down 1,200. So first step then is we want to record our initial down payment for this vehicle. So we can go ahead and categorize it. We can also select the vendor or the person that we paid. So let's pretend we went to 5 Star Ford, for example. So this is going to be a Ford dealership that we paid. And what account is this going to go to? Is it going to go to an expense account? No, it's not. It is a fixed asset. It's above $2,500. Typically, any more expensive equipment above 2,500, we want to put on the balance sheet and capitalize it as a fixed asset. So I'm going to see if we have a vehicle account. I don't see that. Maybe car. No, I don't see anything in regards to that type of account. I can scroll through and see if I see any fixed asset accounts in here. Okay, we do have one called truck. So I can add it to this truck account if I want to, or I can be more specific. So we can do it either way. I'm going to choose to be more specific, okay? You could add it to truck. It'll show up because it's a fixed asset. It'll show up on your balance sheet. That's perfectly fine. But let's be more specific and create a new account. And I'm going to call it Ford F-150. Okay. And I'm going to add this new account. It'll pop open and it's going to make me type it again. So Ford F-150. What is the account type? It's not an expense. It's going to be a fixed asset. Okay. Now, what's the detail? Let's go ahead and make the detail. There should be a vehicles. Yeah, here's a vehicles right here. Now, you may be tempted to put the full purchase price here. You can. Um, I'm going to show you the way to do it via journal entry. So there are going to be different ways to do this. In today's video, this will be via journal entry. So for now, what we want to do is just categorize the down payment piece of this. So for description, I'm going to mention that this is the down payment for Ford F-150. You can add the VIN number. You can put as much detail as you'd like here. And I'm going to go ahead and hit save. And, as you may know as well, you can add more details here. You can add tags. You can add a memo. So I might want to say this is the down payment for F-150. So I can add details, I can add an attachment. I always recommend adding um, attachments, and the benefit to that is you've got the paper trail right here in QuickBooks, so that's a great option. So anyway, for now I'm going to go ahead and click add, and now I want to show you now kind of what that's done. So you may be familiar with looking at your reports and pulling up your income statement or your profit and loss, right? And so this is where you can see information on your income and expenses, right? So this $1,200 down payment will not show up on your profit and loss because we capitalized it as a fixed asset. So instead, we're going to see this on the balance sheet. So when you go to your balance sheet report, we should be able to see under fixed assets right here, Ford F-150, $1,200. Okay, so you can ignore this other truck that was previously, reported. Some people like to do these sub accounts. So, for example, they created a fixed asset called truck, and then they have a sub account called original cost. To me, this is a little messy. I prefer just to have each vehicle, named, for example, as its own account. So this is how I do it, but obviously that you can do it in many different ways. You can create sub accounts, you can create accumulated depreciation per fixed asset, or you can just have and in today's video I'm going to show you just doing one accumulated depreciation total. So we'll get there in a moment. So for now, we have $1,200 in our fixed asset. However, we know that this cost us $50,000, and we have this big loan that we're going to have to start making payments on next month, right? So the next step is going to be to add the other piece of this, and we can do this via journal entry. So the way to do a journal entry will be this plus new icon. There's going to be a journal entry button right here. Now, a journal entry may seem a little scary if you're not super familiar with accounting, or maybe you took an accounting course in college and have nightmares about journal entries, but this will be super simple. I hope to make this make sense. So what we want to do first is make sure our date is correct. So maybe I'm a month or two, behind, and I actually bought this vehicle in 2024. Well, it'd be super important to change this date to December 2024, whenever it was that I purchased it. Um, and I believe the transaction from that down payment was just a couple days ago in the bank feed. So let's just assume it was the 21st, and that'll be fine for the sake of this video. I know it was sometime in February of 2025. So what we're going to want to do is we're going to want to debit the fixed asset account to increase it. So we need to increase that F-150 account on the balance sheet by that loan balance. So the account is going to be the account I created just a moment ago called Ford F-150. And I want to debit this account by 48,800, which is the difference between the full purchase price and that down payment that I had. Under description, I always like to add, description here, and I'll show you why in a moment. But for description, I'll just say Ford F-150, financed portion. And that will give us some more information as to why we're doing this journal entry. Now, what is the offset of this account? Well, it's the liability, right? You went out, you got this loan for your business, so we need to add the loan to the books. So I'm going to create a loan. I'll call it Ford F-150, I'll just call it note payable. And I can add this as a long-term liability. So under account types, this is kind of the opposite of the asset. It's the liability. So I want to add this as a long-term liability because I'm going to be paying this off over, more than just 1 year's time. So that's long-term. I'm going to call this notes payable. See, I could have, again, when you set these up, there are different ways you can do them. I could have potentially added the unpaid balance here, but what we're doing for now is via the journal entry method. So I'm going to leave this blank, and for description, I will add Ford F-150 financed portion, and I'm going to hit save, and that's actually added that description for me there. Awesome. So now I've got my dates, My journal entry number is 1. Maybe I'll put my initials, Nick Grantham, so I can remember that I'm the one who did this. Also, I can scroll down and add an attachment. I can add the loan agreement documents if I have them. So I'll hit save and close once I'm done. And now if I rerun my balance sheet report, if I hit run report, and this is as of today's date basically, I'm going to see my fixed assets are now 50,000 for this F-150. And if I scroll down on the liability side, Ford F-150 note payable 48.8. So you can see that this has been added now to my books. So if I click on the 50,000 and drill down, I can see the 2 different transactions that this is made up of. So number 1 was this down payment expense that's money that left my bank account, and then the second transaction is a journal entry where I'm just recording this loan that's now out there in the name of my business. So the total is 50,000. We've got 50,000 fixed assets. The offset is cash leaving the bank account and a loan for the difference, 48,800. So now we've added it to the books. That's the first step. Now what's going to start happening is next month, the month after that, each month for the next 5 years, you're going to be paying these monthly payments, right? And so you're going to start seeing those hit your bank account. And so when that happens, a mistake that we see quite often is people will categorize those payments to the fixed asset account, and that's not correct. We have already done our part by adding the fixed asset at its full purchase price onto the books. So now, as you make these payments, it's going to be important that these payments are getting categorized against that long-term liability. And what that will do is reduce that long-term liability. So, I'm in this sample company, so we're going to have to pretend just a little bit here. But here's a payment for $800. So let's just pretend that this was, and I know the date is actually before um, the down payment that we added, but let's just pretend this was, in March, for example, and we have now paid $800, and this is our first payment against that loan. So we're paying forward, and then for the account, let's go ahead and say we're going to go ahead and select our Ford F-150 notes payable account that we just created. And I'm going to hit add. And again, I can add memos, I can add attachments, but for now I'm just going to add it as it is. And then when I go to my balance sheet, reports, balance sheet, as of today, if I go down, do you see how this now went from 48,800 to 48,000? That's because we're applying one payment against it. So each time a payment is made, this liability is going to start reducing. The fixed asset account will remain the same. So this stays at 50,000. The payments start to reduce this number.